I'm going to pull up the EA function in just a moment for the Stock 600, which tells us how earnings season has been doing. And I've used the word sluggish because it's very early days. You can't really draw too many conclusions. We're very, not very far into the process, are we? But it does seem as if we have had some disappointments. Today, a few more beats, maybe, a few more positive sounds. What's your assessment so far?
I don't think it's going to be plain sailing through this earnings season because it's obviously coming at a time that economic growth is starting to soften around the world. And in particular, investors are concerned about peak data coming out of the US, which has obviously been the market that really has been keeping the global economy ticking over very nicely. So coming into this, investor sentiment is still quite high with regards to earnings growth. And so really it is that outlook statement that you referred to a few moments ago that people will be scrutinising to give us an indication into earnings momentum as we head into 2019.
Matt.
Earnings growth has really been strong. In fact, I look at the EA chart. You've got it up there for the S&P or the B 500. I've got it here for the S&P. 22% earnings growth, and the surprises have been strong as well. If I click on this, surprise panel here, we can see 4.3% on earnings, 0.5% there on sales. When you say peak, does that mean this is the top? Is this as good as it gets?
When I say peak, I'm talking about peak data broadly, whether that be macro data, sentiment both from companies as well as consumers. But ultimately, it does translate into peak earnings growth. You know, when we look at the quarter-by-quarter earnings profile, third quarter earnings, we do think on aggregate are going to be strong. You know, the market expects that, but you're going to see, 20 to 25% earnings growth. Comparatives then get a little tougher as you head into the fourth quarter, because you remember how strong those numbers were through the end of last year. And as we go into next year for the US in particular, all of the fiscal, the tax package that has taken earnings growth to around that mid-20 level, that obviously starts to fall away. So we still think that the corporate profit cycle is going to be resilient. We're looking for 7 to 9% earnings growth for 2019 for the US in aggregate. But that obviously follows, mid-20s in 2017 and 18. So you're just starting to see, a more normal corporate profit cycle.
A more normal profit cycle with a Fed that is increasingly talking at least about restrictive rates. How do you see that playing out, Grace? Is this something that you're factoring into when does the bull market end? And if so, is it 2019, 2020? When do you see it?
It absolutely is. We're watching this very closely because I think when you look at Fed intentions, and actually we think that they're going to keep going at a quarterly pace through 2019 as well. So we don't forecast respite from the Fed into our base case. You start to get to a point where the yield curve flattens or inverts through the middle of 2019. I'm talking about the 2s-10s spread there. And obviously that does, on a historic basis, start the clock ticking for when the equity market peak is, which is always historically after that curve inversion, but follows in some sort of 6 to 10 month gap. So we're watching fixed income markets, but we don't think that the time's up yet, and it's still worth taking risk in equities.